I'm Randy Wilburn, Director of Education at Zweig Group. Welcome to our online ZLearning course, How You Can Be a Better Financial Manager, Part 1, Accounting 101. This 1-hour continuing education program will help you to develop and strengthen your financial and accounting skills. You may not end up taking over for your CFO or controller, but you will be able to have a conversation with them and begin to understand what they are talking about and how it relates to the projects that you are working on or managing. This is the first of a 3-part series that you can watch on financial management for the design industry. Make sure you download and print out the notebook that comes along with this accompanied video that will help you follow along and take notes as you listen to these amazing instructors today. Our guests today are Jamie Claire Kaiser, Director of Consulting at Zweig Group, and Robert McCauley, a consultant here at Zweig Group and a financial and accounting specialist and a recent CPA, not necessarily a graduate, but you just got your CPA exam passer, which is huge. So you certainly have the expertise and skill set, and Jamie Claire has a considerable amount of experience in this space. And so we're really excited to have you guys both here today to come and talk a little bit about, financial management and accounting from the project manager perspective. Certainly none of these individuals that are watching this video are going to go out and do any mergers or acquisitions, at least we don't think, but this is an opportunity for individuals to gain some additional perspective about, understanding financial, just the nomenclature, understanding accounting basics so that they can do their job better each and every day. And so we've come up with a range of simple ideas and themes to kind of help everyone make sense of the numbers, whether you're working on project utilization, trying to read a balance sheet, or just want to know what EBITDA is, which is like my favorite word in the whole financial dictionary. I certainly know I want to learn more about that, but you're definitely watching the right video if that's the case. This is the first of a 3-part series that you can watch on financial management for the design industry, and we're going to focus today on Accounting 101, how you can be a better financial manager. And really want to thank you both for coming on today. How are you guys doing?
Great.
Doing well this morning. How are you?
Good. I'm glad to be here and glad to be with you. Let's walk step by step through some simple ways that our audience of engineers and architects can develop and fine-tune their financial and accounting skills.
Well, so I think we're pretty excited. If they're like any of the architects and engineers that we know, they'll catch on pretty quick.
Absolutely. This is a smart group, so this shouldn't be that difficult. Robert and Jamie, when it comes to accounting best practices, can you walk us through some of the different methods of accounting? And you don't have to fight. You guys can just pick and choose which ones you want to jump in and talk about. But why don't you kind of let's start there with the foundations of accounting.
I'll defer to the CPA in the room to start this conversation.
Okay.
Excellent. So first we'll just go over the two main methods of accounting.
Okay.
Which are cash basis and accrual basis.
Okay.
Cash basis is more common among smaller companies, and that's where you don't recognize, or you recognize the revenue expense based on the cash you receive or the cash you pay out. And so it's very hard cash oriented. You're recognizing revenue when the cash comes in, not when accounts receivable comes in, but when the actual cash comes in, and you're not recognizing the expense until the cash is directly paid out, and not necessarily payable. Whereas the accrual basis is where you're recognizing the revenue on a kind of, you're matching the revenue expenses with the time that they happen. And so you may have a 2-year contract for $10,000 in year one, and you're going to recognize that revenue in year one.
Okay.
because you received that contract in year one. And whereas the cash basis, you would receive only the cash you received in year one, and then the cash you received in the year two, the final year of the contract in year two.
Okay.
It makes a huge difference in this industry too, especially when you consider that the average collection period is something like 76 days, I believe, this year.
Yeah.
So there's a huge difference in how you're accounting for it because there's so much time that passes between invoicing and receiving.
Right. Okay. And Jamie Claire, why don't you, just to kind of take it a little bit further, but given all of your experience with a wide variety of firms in the design industry, with these two different methods of accounting, cash basis and accrual basis, which one is preferred or kind of a hybrid of them both being used?
Well, I would actually say a hybrid method is the most commonly one. Most firms will recognize revenue on an accrual basis, so when the invoice goes out, when it's billed, and then they'll recognize expenses on a cash basis. I would say it's called modified cash.
Modified cash basis.
Yeah.
Okay.
I think that's probably what we see the most often, and I think it makes the most sense in this industry too. You have to keep track of all of them. You have to keep track of your cash basis, or you may not make payroll. Just because you've invoiced it doesn't mean you have cash in the bank.
Right.
But if you over-focus on accrual and don't focus enough on collection, you can similarly not make payroll.
Yeah, okay.
So it's important to keep an eye on both. But I think most firms, I would say, follow a modified method for internal purposes.
Okay. All right. Well, that's cool. Robert, there are so many terms and acronyms used in accounting. What would be the best way for a novice to learn them all, or better yet, determine which ones are the most important to remember?
Yeah, Randy, I think before we kind of get into the terms and the metrics a little bit later on, it's really important to realize that just in the basic income statement, there's two parts. You've got your revenue and your expenses, and it's very easy to focus on those revenues because that's the cash, and that's what's coming into your business. But I would say it's more important to focus on what's at the bottom, the EBITDA and the operating income, which is revenues minus expenses, because if you focus too much on revenue, your expenses can be growing at the same rate, and your margin, your profit margin, your EBITDA margin is staying the same, and you're not really growing your business. You're kind of just increasing the numbers. And so you want to increase your revenue while limiting your expenses or trying to taper those off.
Okay. All right. And there's that fancy word again, EBITDA.
EBITDA. It's a magic word, isn't it?
It is a magic word, and just for the interest of our audience, why don't we talk about EBITDA just a little bit, just so they have a better understanding, because people flout that word around, and I honestly believe
it's a fancy word.
It's a fancy word, but some people use it and they still don't know really what it means, and that's why I think it's kind of cool just to break it down. And on the video, what we'll do is we'll kind of give some images to show and really elaborate on what you are describing, but just so the audience has a better understanding. Why don't you kind of break it down in its I know it stands for different things. So
yeah, and so to get to EBITDA, let's just first get to operating income. You're going to do revenues minus direct labor and minus other operating expenses, general admin, and expenses to help you run your business on a day-to-day basis. So that gets you to operating income. And within those operating expenses, you'll include interest and taxes and depreciation amortization, and that's where the EBITDA comes from. The E is earnings before interest, taxes, depreciation, amortization.
Okay.
And so your operating income, and you want to add back those expenses because, for one, the interest and the taxes are going to be different across regions and across different tax jurisdictions.
Right.
And interest is something that's not really correlated with the operation of your business. And then the depreciation amortization is not a cash flow expense. It's an annual expense from an asset that you purchased, and it changes with the type of depreciation method you chose to use for your business. So it's not necessarily, you're not paying anything that year, it's just expensing an old asset year after year. And so it's not necessarily an expense, it's reducing a fixed asset.